Hi, my name's Simon Halberstam. I'm head of the Technology Law Department at Simons, Muirhead and Burton. My day-to-day existence comprises looking at commercial contracts for technology companies, data protection issues, and all the interesting aspects of intellectual property rights. But there's also stuff that I cannot do for my clients, fundamentally corporate work, and a lot of that relates to M&A, share option schemes, and in particular fundraising. And on all of those matters, I'm very glad to be able to defer to my learned colleague, David Martin, one of the partners in our corporate team, who deals on a day-to-day basis with all of those issues that I find too complex. So for corporate stuff, fundraising, David, maybe you could give us some views as to the sort of stuff that you do on a general basis.
Thank you, Simon. So, as Simon said, I'm David Martin. I'm one of the corporate partners at Simons, Muirhead and Burton. We're a business law firm based in the West End of London. I've spent my entire professional career, sort of over the last 14 years or so, helping mostly entrepreneurial clients through the whole life cycle of their business. So that's from someone having an idea to eventually growing that business and then exiting through a trade sale or an IPO. And as you can imagine, there have been an awful lot of fundraisings in that time.
I know because I sort of catch the beginning or the ends of these conversations, but not involved right in the centre of them often. Sometimes people obviously struggle to find any source of funding, but sometimes people have an interesting technology prospect in terms of what they've developed or what they're planning to develop, and they have different offers from different people. So they may have different investors lining up, and they may have different types of funding. What's your general view and take on how to assess what's the best thing to do and with whom?
I mean, choice of investor, definitely a bit of a luxury. Many startups, are just desperate for funding wherever they can get it because it is, very difficult to find that funding. But I think it's definitely worth understanding some of the pros and cons before you target particular types of investor. And if you are in that enviable position of being able to choose between different people, generally as a rule, the sort of bigger and more sophisticated an investor, the harder deal they will strike, the more specific they will be, and the more inflexible about their terms. And generally, people investing their own money are actually more relaxed about those terms than people investing other people's monies. So, often the first source of funding for a startup is a friends and family round, which can work really well in terms of getting quite flexible terms and raising money quite quickly without too involved a process. But just bear in mind the amount you can raise might well be limited. Certainly those investors' ability to follow on and keep funding the company as you grow can be limited. And if you're marshalling an investor group of 10 or 20 people, that can be quite a job in itself. There's also looking to private investors for money, which has some of the sort of similar drawbacks in they don't always have very deep pockets to follow on with their investment. And if you're having to deal with lots of people to raise that money, that can take quite a lot of time. But if you use the government's SEIS and EIS tax incentive schemes, which are particular schemes designed to encourage private individuals to invest in high-risk startups and have some quite attractive tax advantages for your investors, that can really help you raise money. You can also look at angel investors who may bring particular expertise that is useful as well as the money, or they may have a contact book they can open to you and that can help. But they can also be quite, drive quite hard bargains, as I think, everyone's seen on Dragon's Den. There's also family offices. So that's, a group of a wealthy family have a sort of internal organisation managing their wealth for them. And that can be quite a nice balance between having deep pockets and able to invest considerable sums of money, only having to deal with one investor, but at the same time they can be a bit more flexible on terms and willing to be a bit more commercial in those terms. Last but by no means least, at least there's venture capital firms which tend to have, very deep pockets. Some of them can have, big names which can open doors in terms of other investors wanting to sort of piggyback on their expertise and the work they've done, investigating the business, testing the business model. But the downsides of VCs are they drive a notoriously hard bargain. They'll tend to have quite fixed ideas about the deal terms. They won't be very sort of flexible in what they're willing to offer. And also they'll want a lot of monitoring. They have a big internal infrastructure of people whose job it is to monitor the investment. So you'll find you spend a lot of time sort of providing the information that they need and answering their analysts' questions.
When you've got to the end of the process of determining, assuming you have that luxury, who are the best people from whom to take funds, one of the other issues obviously you'll have to grapple with, and in conjunction with them, is what's an appropriate valuation. It seems to me very much like a dark art, and people just sort of stick a finger in the air. How do companies realistically determine what's an appropriate valuation, and at the same time, how much to raise, and how much to give away for what they're raising?
You're not wrong there. Valuation is definitely an art and not a science. There's a couple of different methods that people use. Once a business is revenue generating, you can value on the basis of EBITDA, which is earnings before interest, tax, depreciation and amortization. But if you don't have earnings, or if you don't think that accurately reflects the potential growth that you expect to see, which is the usual position in a startup, that's not much help. Quite often startups use comparables. They take another business that they think is similar in their industry and say, well, they raised money at this value and so we should be worth the same. But that isn't definitive and has limitations. Ultimately, the value of the business is what someone's willing to pay. So there is an element of finger in the air and see what you can get. The one thing we would say is we always caution against overvaluing, just because even if you get a really brilliant price now, you're likely to have to raise more money later on. That could be at a lower valuation, and a down round isn't a great investor story. It can upset existing investors and can make it, a harder sell.
At what point of the life cycle, early stages, because there are all these different types of funding, seed, Series A, Series B, etc. At what point is it usually appropriate for companies to raise funds? Is it when they're really up against it, or when they're actually got a buffer of a cash pile so they don't look desperate and they're not so subject to oppressive terms?
We would definitely say raise money before you really need it. There's nothing worse than being in a position where you're 2 weeks from the end of the month and you can't make payroll unless you close that deal. In terms of timelines, it's very difficult to say definitively how long it's going to take. The only hard and fast rule we've ever found is probably twice as long as everyone expected when we started the process, and it's likely to be months rather than weeks. And there are some sort of alternative sources of funding that may or may not be appropriate depending on the sort of stage of the business. It's definitely worth thinking about government grants if they're available to you at any time, and they don't need to be driven necessarily by what you're doing in terms of equity fundraisings. The business may also be able to support debt funding, depending on its stage.
I've seen over the years that lots of my clients in the process of fundraising really take their eyes off the commercial ball, because obviously it's a complicated process. You may have to talk to all sorts of people in order to try and find somebody who's actually going to invest in you, and then they'll want to do extensive due diligence. Two things really here. One is, what sort of insight or tips can you give as to how companies can make that process as painless as possible, in terms of whether it's their own preparation or whether it's sort of engaging an intermediary to help them in the process? What are your thoughts on that?
I think definitely if you know that you're going to be going out and raising money, you know that almost certainly the investor's going to want to do some due diligence. So even before you start approaching investors, you can start that process running. You can get together all of your sort of important legal documents and contracts that you think an investor is going to want to see, and put them into an online data room so that you're ready to go as soon as you're getting close to term sheet and a confidentiality agreement is signed. Then you can just give your potential investor access. And also use this as an opportunity to have a bit of a review of the business. Think about any gaps, think about where there may be skeletons in the closet, any kind of issues that you've been meaning to get around to dealing with, any trademarks you meant to register but haven't had time yet, and try and preempt some of the likely investor issues, which has kind of two benefits. One, it'll speed up any due diligence process with the investor, and also it gives them the comfort that they're investing in a well-run business.
Now I can say, without blushing too much, my many years in the business, I have found being a commercial lawyer, corporate lawyer is very difficult to engage with, because whereas I pride myself on efficiency and transparency and clarity of costs, corporate lawyers often are more turgid, and they also don't really get technology in the same way as commercial lawyers do, who actually have to do contracts relating to the technology, because the fundraising aspect is a bit sort of agnostic as to what kind of company it is. But I found you, without making you blush, extremely easy to deal with, because not only do you get technology, but you're very clear on costs as well as extremely efficient. What tips for anybody trying to engage with a lawyer, if they can't get hold of you obviously, would you give them in terms of what to determine in terms as to which the right sort of lawyer is, what the right signs are, and what to put in front of the lawyer in order to try and get the best relationship?
Firstly, thank you for your kind words. I think in terms of engaging a lawyer, it's very important to engage a lawyer who has experience in doing what you want to do. So it may be the first time that you're going through this process, but you need a legal partner who's been through it before and can guide you through. It'll also save a lot of time, effort and money ultimately if they know what's market and what isn't, so they know which elements of the deal they should push on and which, unfortunately you'll just have to accept if you want to unlock this funding. And that should save a lot of time overall and a lot of friction in negotiating the long form documents. It's also very important to have a lawyer who's going to be responsive. These kind of deals are complicated. There are a lot of moving parts, tend to be a lot of people involved, and you want to try and minimise any delays from any element of the process or any party who's involved, so that you keep that momentum up and get to completion as soon as possible. And finally, I guess I would agree with what you say. I think transparency about costs is very important. I think fixed pricing wherever possible is fantastic. Making exactly clear what who's doing what and what it's going to cost, and potentially where there are elements of the work that doesn't need a lawyer to do, potentially that you can do yourself or with a bit of guidance from the lawyer, so that there's some sort of flexibility, and the whole kind of transaction has been split into the component parts, so you're clear who needs to do what and when and what it's going to cost.
Obviously it's not always at the instigation of the company that wants to be invested in to determine how much it's going to raise, because investors have got to be willing to pump that amount of money into the company based on the fundamentals and what they see as the prospects for the company. But if you could give some sort of guidance as to what's an appropriate amount to raise at different junctures, what would you say on that point?
Good question. I think a lot of the time there'll be specific kind of milestones that the business might need. It might know it needs X amount of pounds to get to a point where it's cash generative, or to get to a minimum viable product, or kind of the next stage in its development. And then we would say raise enough to get to that next milestone, and possibly add a cushion of maybe 20% for contingencies. Other times you'll think, what is our projected cash burn? We want to maybe raise enough for two and a half years, so that we've got a year to actually run the business, and then an additional year where we can start fundraising, plus a little bit of time for delays. In terms of things to think about when looking at how much to raise, it can be attractive to raise much more than you need now, so that you don't have that distraction of fundraising, which it may feel like it for some founders and chief executives that that's all they do. So if they've got cash in the bank, it's great that they can get on with actually building the business and not have to worry about raising money. But the downside can be you would hope that a later fundraising would be at a higher value. So the more you raise now, the more you're going to dilute down your and the existing shareholders' stakes in the business. Another consideration to think about is to make sure that, as you're diluted in this round as a founder, and as you're diluted later on, you never give up too much of the business.
One of the things I like about the way you deal with my clients is how clear you are on the pricing of jobs to be done, particularly in the context of fundraising. And you have this sort of menu pricing when you break down the different elements into individual prices, which of course ultimately adds up to the total. And you make it quite clear that some of those elements, in order to save costs, should the client want to do so, can be done by the client itself. Obviously not the detailed legal stuff. How is that sort of best presented to a client? What are those elements where clients can actually, if they wish to, save some money by doing jobs that the lawyers don't really need to be involved in?
Yeah. So we act for a lot of startups who really need to be getting the maximum bang from their legal buck. So we're always trying to help them, to save money, to get the most out of their legal spend. Whether that's us doing things as efficiently as possible, or whether that's helping them to do things more efficiently. And there are certainly some elements of the transaction that we definitely need to do. We should be drafting legal documents and reviewing those legal documents. But there's quite a lot of things that a lawyer does that don't necessarily need a lawyer to do them. One good example can be just chasing down signatures. If you've got a cap table or a shareholder register with 30 or 40 names, just getting everyone who needs to sign a shareholders agreement, even if they're all in complete agreement with it, can be quite a process in itself. But you don't necessarily need legal training to follow up with people and make sure that they provide the right documents at the right time. So that's something that we often say to our clients, we can provide that service for you if you want, but if you're happy doing it yourself, it'll help you reduce your bills.